You don't have to be in the market all the time. And that notion of yours that people feel that they call themselves a trader, they have to be trading, I think is very, very true and very, very pertinent. But they don't realise that you can still be a trader by taking a handful of positions a year and just letting them go.
Welcome back everyone to the MC Allen with Christopher Tate. We spoke a while back. I'm not sure exactly when. It's been a long time. Christopher is a trader out of Australia who's trading now full-time. How's it going, Chris, today?
It's a rather chilly autumn day here in Melbourne. And that's about the most exciting thing of my day so far. Well, other than talking to you. That's always really exciting.
Awesome. That's going to go well for sure. So it's good to catch up for sure. Good to talk with you again. I want to hear a bit more about kind of what has changed. And we discussed this off recording before, but what has been going on with you for the past, I guess, 2-3 years since we last spoke?
I think simply the expression COVID covers really everything. We were fortunate here in Melbourne in that we set a world record in that we had the longest lockdown period of any city in the world. And that really has, it's interesting because I was having this conversation with someone the other day and we noted that something has changed, but we don't know what. So when you go out, there are not as many people around. It's not that the city is deserted, it's just that with the work from home, it's normally full of people. Cafes are normally full. Even my local cafe is not full. And when there are people there, everyone chooses to sit outside. So the world does seem to be slightly different than it was, 2.5, nearly 3 years ago now.
That's interesting. And it's probably the same, I guess, all around the world. Some countries are getting back on track faster. Some countries are slower. I kind of want to hear about what effect has that had on the markets? Has it been the same trading in the past 2 years compared to before that, or is it different?
I think my view, and I was thinking about this morning when I was just scrolling through things, is that I always have a sense of surprise that people are surprised that markets go down. So if we talk about markets just as a general thing, just an overarching view, I don't actually think, I think markets in many ways are immune to shocks like COVID. There was the initial COVID sort of drop in 2020 when we had a very, very short, sharp fall. Markets then recovered and went on their merry way. And I think in part because what happens is people confuse the economy with the market. And the market is not the economy, it never has been. The market is merely an aggregation of people's future expectations of what things might or might not be worth. And particularly in the US and through certain commodities, we saw very, very buoyant markets through COVID, right up until the time they stopped being buoyant in the past few weeks. And what does surprise me is that people are always surprised when things go down. People are surprised that the NASDAQ, which after a generation of going up, has decided to unravel a little bit. And there's all this bedwetting about the fact that an entire new generation of investors and traders have discovered the fact that prices actually go down. And it doesn't matter what instrument you have. It doesn't matter whether it's Netflix, Walmart, Luna, Bitcoin, Ether. The law of gravity for instrument prices has never been repealed to my knowledge. So they still can go down, and they do. And I think a lot of the distress people are feeling now is that they've not actually experienced that. This is completely new to them. So that when you look at things like Twitter, my Twitter feed is abuzz with people who are coming apart at the seams because they've discovered that prices go down. Now that distress is the endpoint of doing stupid things like leveraging yourself to the hilt, drawing down all the equity in your home, selling your family home and sticking it all in Luna, and now it's worthless. So they're the endpoint of stupid financial decisions. But the distress is still real, that people have woken up and it's dawned on them that things have actually gone down. And the problem is when you've had a market that's gone up for a generation, you don't learn things like money management, you don't learn things like risk control, you don't learn about stops because, well, you don't really need them because nothing ever goes down. And that's old school and old-fashioned thinking. Unfortunately, it's not. And all markets go through these cycles. Prices go up for year after year after year, and then they suddenly decide to go down. And it's a race to see who can find a chair to sit on.
That's a good point. Now, does that mean that for you, fundamentals don't really matter in the market? Because you mentioned the economy is different. Sometimes people look at the economy to predict the market, but those are two different things.
Not at all. I've tried to rein my opinion in as I've gotten older and be a little bit more circumspect, in that when I was a broker, I used to laugh openly at our analysts at our morning meetings, because they would come away with all sorts of idiot pronouncements about the market or a stock price or something or other, and they were all invariably wrong. And they're invariably wrong because what they're attempting to do is to divine what the trend should be from very, very sketchy information that they've put together. I use a site called Koifin, which is a free site. And one of the charting features it enables you to do is to pick a stock and overlay analyst estimates over the top of it. They're always invariably wrong. And this is true about economists. There's a joke we have here in Australia, and I'm certain it's universal, that says that economists have predicted 23 of the past 4 recessions. And there is this constant need for people who engage in fundamentals to make a prediction. What they don't understand is that the price of any instrument is not dictated by what is occurring with the instrument. The archetypal example of this is cryptocurrency. Cryptos are essential. Look, this will upset people. My view is Bitcoin is useless as a store of value. It has no intrinsic value whatsoever. It's shown to be a very, very poor hedge against inflation because it's now perfectly correlated with the NASDAQ. But that doesn't mean it's not a good instrument for trading, and that doesn't mean that its price cannot go up. And we saw this in the dot-com boom. There were literally thousands of rubbish stocks with extraordinary valuations. Did nothing, made no money, went nowhere. But that doesn't matter. All that matters is the price. And all that then matters is, can you make a delineation that says, right, according to my system, according to the way I see the world, the price last week was here, it's now here, therefore it is trending up, therefore I'm a buyer. That's the only delineation you need to make. And once you can make that decision clearly, then I won't say trading becomes easier, because it's never easy. The rules are very simple. The emotional components are very difficult. But the ability to spot a trend is a fundamental skill. Is it trending up or trending down? And you've automatically given yourself an edge, because one of the rules that flows from that is simply the rule, I will not buy things that are trending down. And that automatically makes you superior to a vast raft of people. An example I'll give you is the people who have been buying Netflix all the way down. Now, if you had a trend following system, the moment it broke its long-term uptrend, you would either become a seller or you become neutral. You wouldn't become a buyer. And we've seen this destruction of, the destruction of wealth that can occur when people do that, simply by looking at the ARK ETF run by Cathie Wood. She engages in averaging down. And I did an exercise a few weeks ago that looked at her portfolio of about 35 stocks. And the majority of them need to gain several 100% from her average down entry price to get back to where they show her to be profitable. Now, if she just had a rule that said, I don't buy things that are trending down, she'd still be the darling of Wall Street instead of a real pariah who is really taking a savaging. And so it's just that ability to go, well, price is trending up, I'm a buyer, price is trending down, I'm a seller, or I'm stepping out of the market until conditions are conducive to me. This notion about building a narrative about what you think something should be worth, I think is a fairly pointless exercise, because the only true definer of what something is worth is the market. If the market says Netflix is worth $140, it's worth $140. It doesn't matter whether you think it's worth $700. You can't convince the market or anybody else it's worth $700 because the market says it's worth $140, and that's it. And to a degree, there's a lot of arrogance and a lot of ego in that sort of pronouncement, that sort of position taking, that you think you know. In trading, you just have to accept you don't know. You don't know anything.
I know a lot of people are going to ask in the comment section for sure, so I might as well ask you now is, what is your favorite tool or way to look at the trend? Do you have any kind of preferred time frame, any kind of preferred instrument or tools or to look at the trend?
I am a longer term trend follower, and my action, this is going to sound rather basic, but it comes from my early days when we didn't have access to all these computerized tools. My favorite tool is simply a break of support or resistance. It is the capacity to draw a straight line. And it is that capacity to say, well, prices had been at this level and were being rejected, and now above that level. I'm now a buyer. And I've always found that to be remarkably reliable for the way I see the world. And in terms of time frame, I moved away from very short-term time frames a long time ago simply because, to my way of thinking, they do not offer the chances to participate in very long-term trends that do very, very well. I have some young friends who are constantly sort of popping up on Twitter going, I made 1R today, and I'm thinking, you spent all day looking at the screen for 8 hours to simply get a single-digit return on your risk. To me, that's not worth it. That's just not worth time and effort. But my preference is to build a position whereby at the end of it, and I've no idea how long they last for, you walk away with deep double-digit returns. So you risk one, you walk away with 20, 30, 40, 50, not picking up one here, one there. That to me I find to be, it's almost like having a job. And one of the good things about trading is it's not really a job. So I don't know why you would craft a trading method that replaced your job, that forced you to sit here looking at the screen for 8 hours a day. I get up, I scroll through my small list of instruments, and I'm done and dusted in under 30 minutes. And that's it. And then I have to find something else to fill the day. But there is a problem with that. And the problem is finding something to fill the rest of your day. And I think this is why people move to short-term trading. They either move to it out of boredom, because they're simply bored. You sit here just looking at things. Or they believe that the mythology that the more you trade, the more you make. Unfortunately, when you look at both the evidence from the literature and also observations of other people's experience and my own, the more you trade, the less you make. And there's a few reasons for that. Of course, there's the fundamental reason of your cost generation. You're simply burning money. You're making brokers wealthy. The second is that you're missing out on those long-term moves because you're seeing only tiny fractions of them. Case in point, we have a student who bought one of our domestically listed mining stocks, Paladin. Bought it at 5 cents. We in Australia, because of the way the market is structured, we have a lot of what we call penny dreadfuls. They would be called dog stocks overseas. They're very, very small miners. And the Australian market is split between, sort of investment grade stocks and these very, very small miners, which occupy a lot of the market. He bought it at 5, sold it at 7.5. It went to $10. He left several $1 million on the table. And he did that because instead of being able to step back and take a view of the stock, he was jammed up close. And he thought, well, making 2.5 cents on 5 cents is 50%. That's brilliant. But because he had several 100,000, and it's not an inconsequential amount of money by any stretch of the imagination, but he still left several million on the table. And it's one of those decisions that haunted his trading from that point on. And it is actually good to have lessons like that say, look, what is the big picture. I don't know whether you can see behind me, I have a couch, which is good for afternoon naps. But I also throw my charts up onto this large monitor I have at the other end of the room, and I sit back there and I simply scroll through them. And it's very, very easy to see what the big picture is. I think the unfortunate thing with traders is they become very myopic. They jam themselves up against price action, and they can't see what else is happening because they're so intent on sort of the changing numbers and the flashing colours and all the rest. And when I changed my trading decades and decades ago and I actually started to look at weekly charts, it was an utter revelation. It was staggering and distressing, the size of the moves that were occurring and the amount of the move I was missing. And I was missing it because, like others, I was jammed up against price and simply obsessed with the little rotating numbers instead of switching that off and taking a much broader view that said, well, this instrument's going up. I need to be long and I need to continue to find reasons to be long. Not I've made a little bit of money, I'll get out and look for something else. And unfortunately that brings in boredom, and boredom is the enemy of all traders because boredom leads to tinkering. And once you begin to tinker with your trading system, it's pretty much all over.
That's a really good point you make. The fact that, and a lot of people are looking to like be more active in the market. I think it's a fear of like you're not doing enough. If you're going to trade like a bigger time frame, you're not doing enough to really succeed or achieve your goals. In that case, that people want to day trade for that. Also, it's like it's insane how much people want to be in the market. Like they want to do that because that's something they feel like if they should be traders, they should be in the market all day and like trade 8 hours a day or more. So
and that's the thing. There is this. The really, really good thing about markets is that you can craft your job description to whatever you want to do. You should never have your job description crafted onto you by the market. And the market's very, very good at compelling people to trade because there's always something happening. And the market is very, very good at unsettling trader psychology. So it's very, very good at getting you to trade badly. And most people trade badly. And again, that comes back to a simple, I think all these things drift back, if you really want to compress them down, to a lack of discipline. It is that inability to stop, to leave something alone. But it's also an inability to understand that, as you say, trading can be anything you want. You don't have to be in the market all the time. And that notion of yours that people feel that if they call themselves a trader, they have to be trading, I think is very, very true and very, very pertinent. But they don't realise that you can still be a trader by taking a handful of positions a year and just letting them go. And at the end of the year, you tally up all the money you've made and gone, well, that worked somewhat rather well. But it's getting to that stage. It's convincing people of that. And the unfortunate thing about social media is that social media is simply another addiction that traders have. They're addicted to, well, let's call it trading. Look, in many ways, it's not really trading. It's what they do is gambling. But social media reinforces that. Because the unfortunate thing about social media is there's no vetting for the truth. And nothing anyone says is ever fact-checked. And I had someone on my social media feed the other day claiming they are up 150,000% since they started trading. So I got out Excel and I just put in a raft of numbers and multiplied them by 150,000%. I couldn't really see this person's name as being one of the richest people in their country or one of the richest people in the world. My guess is they were still living at home in their mother's basement. But unfortunately, people see that and they're compelled to think they need to emulate that. And they're told by people, well, if you just make 1% a day, and there's 250 trading days, in terms of a compounded return, you'll beat everybody in the world. As much as people try to be sensible and look at that, they go, yeah, I can do that. How hard could it be? It's actually really hard. And it even sort of infects LinkedIn. My LinkedIn profile is full of people talking about their equity curve, and their equity curve has no drawdown. It literally starts here and it goes up like that, and it's a straight line, which is fundamentally impossible. So they put up these fake equity curves with fake test results, and you sit there and think, yeah, look, I know it's nonsense, but someone out there won't, and they'll believe it, and they'll either give you money or they'll buy your magic system or they'll try and emulate it, or it sets up an unrealistic expectation. All businesses, trading's a business, have periods where they go wrong. I'm in drawdown at present, but I accept it as part of the natural order of things. It's like owning a restaurant. Not every month owning a restaurant is a winner. You'll have slow months. You'll have months where you lose money. You'll have months where you make a lot of money. All businesses are the same. But again, that's people have an unrealistic expectation as to what trading is. Trading's a business where you never lose money.
I think that's pretty much the worst thing is expectations. Even if someone like bad at that fake system, it's not that bad. But the bad thing is like other people expecting these results for their trading after. And if they don't get this, then they will be discouraged and they will chase this other strategy or this next thing that they want to buy after.
And that's the perfect observation. It is expectation. It is managing those expectations in people that this is a business. Businesses take time to get established. They have good times, they have lean times. There's no doubt in trading that you can make a great deal of money over the long term. There's no doubt about that at all. But I think, again, we come back to that word expectations. People think that they're going to buy the equivalent of a meme stock at 50 cents and sell it at $150. And what will happen is they'll buy the meme stock on Monday at 50 cents, and by Friday it'll be $150, and they'll sell it and they'll go buy an island somewhere. And whilst those sound like silly expectations, that is, I think, largely the expectation of a very, very large number of traders/investors. I had a young lad here this morning, an electrician, just doing some work around the house. And the thing he wanted to talk about, Bitcoin, and how he was just going to keep buying it until it went up again. And I thought, okay, what happens if it never goes up again? And that had never entered into his head. That wasn't a consideration. His expectation was that it would just go up forever. He seems to have noticed the fact that it's halved. But again, expectations.
Good point. Getting back to trading on longer time frames and like longer term trends, I know a lot of people are going to have this issue with testing, and they want to be sure the strategy works and they want to test it. But then if you trade on the weekly chart or something similar, you're going to have to take very few trades over the long term. So how can you actually test that you have an edge when you trade longer time frames?
One of the things about systems is that I have this desire, among all things I do, to simplify, to make them simpler and simpler and simpler and simpler. I'll make a dogmatic generalization. All trend-following systems are profitable over the long term. And they are profitable over the long term if they have appropriate money management. And by trend-following systems, I mean things like moving averages, breakouts to new highs, long-term MACD, all of these things you would traditionally associate with being trend following. The key there is the money management component thereof. But part of the issue that people face is that when you test a system, you'll see something very, very interesting. And it doesn't matter what the system is, and it doesn't matter how you test it. When you build an equity curve, you'll have a point of origin, a dollar figure where you begin. You'll see that dip. Now, that dips automatically because all systems with money management take their losses first. So they accumulate a drawdown and then they take off. But people don't notice that. They don't see that point. What they see is this part of the equity curve here where they're making money. So what happens is that when people get involved in markets and they begin to trade a system, they naturally hit this drawdown. And because they've not, again, come back to that word expectations, because they have no expectation that that would occur, they're taken by surprise. So what they'll automatically do, shut the system down, look for another one and start it. The problem is that exercise then repeats itself. So you go from drawdown to drawdown. They then shut that one down, buy or build another one. It goes into drawdown, they shut that one down. And so all they're merely doing is hopping from drawdown to drawdown to drawdown. They're not giving themselves chance to take part in that rally phase of the equity curve because they're simply not participating long enough. And that's, I think in part, that's the central issue is time. It takes time for trend following systems to build legs and to get going. And that's just a natural part of the way they are. And it doesn't really matter whether that trend following system is built around tick charts, 10-minute charts, 4-hour charts, daily charts, weekly charts. They all take time to get going. And it is that inability to understand that they take time to get going and that you really must persist. The same psychology that drives people's inability to deal with things like weight loss drives their inability to deal with things like drawdown. It seems like an odd comparison. But what happens is that people want to instantly look like someone. They have an image of what they should look like. And as an example, my gym started off years ago with a 12-week program. Then it became 10, then it became 8, then it became 4, because people can't be bothered waiting 12 weeks to look like whoever they want to look like or their ideal shape. Traders are the same. Traders can't wait what the 6 months, the year, the 5 years, the 10 years it takes to actually build a very, very large pool of equity that enables you to do whatever you want. And so we're back to expectations. Expectations are a function of psychology. Humans are badly set up psychologically to trade. We just struggle.
How do you think we can improve that? How do you think we can improve our mindset as traders?
That's a very powerful question. There's a few pragmatic, practical things. One is to simply deal with risk levels that you can handle so that in some way you become inoculated against the fact that markets can and do move against you at times. What I tend to see is that people start with risk levels that are far too high for their experience, the account size, and that generally leads to a somewhat distressing outcome. If you cut the risk level back, I'll give you an example. What are we now? We're now in May. December 29th, I'm out mountain biking, just having a nice time. It's 30 degrees, magnificent day, get chest pains. I had a heart attack mountain biking. It's taken me time to get my rhythm back trading. But to get my rhythm back trading, you go back to trading one lot, one single contract. You go back to trading a fraction of your risk, simply to get your rhythm back and to get that sort of conditioning back. It's a little bit like if you wanted to run a marathon, you wouldn't go out and get off the couch having never run before and go and run 25K. You'd go out and you'd probably jog around the block and you gradually build up. Traders are along the lines of the sort of person who wants to run the marathon, goes out the next day and then tries to run a marathon instead of building up. So you need to drop your risk so that you build conditioning to the fact that markets move against you, price moves against you. It's a business that doesn't always go in your favour. But it's also a matter of having the discipline to manage your expectations as to what you will get. But it's also having the discipline to undertake review. And review simply means sitting down and asking yourself very, very hard questions as to why you did something. Why did I do that? But more importantly, why did I behave that way? What role did I play? Because I think a lot of the times we try and negate our role in things, the part we play. And in trading, yes, there are times when you'll take a position, let's say at 11 a.m., and by 11:05 it has reversed completely and run you over. That sometimes happens, and that's very distressing and very annoying, and sometimes just makes you laugh. But most of the time, what happens is you'll take a position in instrument, say, at 100, it'll close 98 today, closes 96, closes 94, all the way down to 50, and then you sell out. You played the major role in that loss being 50%. The market didn't, you did. Because what markets say to you is, I'm going to give you an opportunity now to exit. Do you wish to exit? And you will respond yes or no, either by, pardon me, exiting or staying. It will then ask you that question again. And it keeps asking you that question. And it is your response that dictates the level of your loss. The problem is that when you come back to review that, you have to say to yourself, the loss was my fault. I am responsible for that occurring. That's very, very difficult for people to do. It's very difficult for people to go, it was my fault. And it was my fault because of these reasons. And these were my feelings and thoughts on the way down. Which leads me to perhaps one of the most powerful things traders can do, and that is to simply journal. It is to write down what you think, what you feel, both when you enter the trade, but also as you manage that trade, because that becomes a book of learnings for you. You can look back and you see, well, I was in this situation before and I felt this. Okay, I no longer feel that. I no longer, say, feel a sense of panic or dread or unease. I feel quite relaxed. And then you think about, well, why might that be? Well, you're more experienced, your risk level is appropriate, and you understand that markets can and do move against you.
That's a good idea. And I think a lot of people, when they start to be responsible for the losses, they start to understand they caused the loss, then they start to feel bad about themselves. They start to feel like they're not good enough to trade. I think journaling can help with that a lot, but I think there's still an aspect of, like, a lot of people feel losers for not winning in the market.
And I think, yeah, that's a very good point. And that is that sense of self-doubt. And all traders have periods of self-doubt where you think to yourself, well, I can't even really buy a winning trade. I've forgotten what winning is like. And you do begin to doubt yourself. But one of the things I do when that occurs is I have a template for the instruments I trade. And I'll put that template up over various bits and pieces. And I'll put the time frame out to 10, 15, 20 years. And I'll just scroll through and I go, well, it saw that breakout. It saw that one. It saw that one. It saw that one. And you begin to start to recover your sense of confidence that you can actually do it. One of the things about trading is it presents us with a number of paradoxes, in that in trading you must be humble enough to admit that you make mistakes, you make errors, you get things wrong. But you've also got to be fantastically egotistical enough to think, screw that, I can do this. And so you're caught with a paradox. And you've always got to be working on this notion of that quiet confidence that you can actually do it. Look, to be honest, my observation over decades is it is not intellectual ability that stops people doing well. Never has been. Trading is very, very simple. If you can use a mobile phone, then you can trade. If you can reset the clock on your microwave, which is the hardest thing I have to do twice a year when daylight saving comes and goes, then you can trade. In terms of the fundamental practical aspects of it, anyone can spot an uptrend, anyone can spot a downtrend. It's having the sort of, I hate the expression emotional intelligence. I think it's a terribly wanker expression, but I can't think of a better one, where you've just got to have that maturity about you to be able to control yourself, because it's not the technical and intellectual aspects of trading that trip people up, not by any stretch of the imagination. It's always their emotional response to what's occurring. That's what blows accounts up. It's playing double or nothing. It's chasing losses. It's letting things decay to zero without taking any action whatsoever. And it is those things which are all emotionally driven, they're all psychological aspects that determine whether you can or can't do this. It's not the system at all. The systems are just a crutch to get you to do something. Because by and large, anything that buys new highs and has risk control works. Now, if that's true, why can't everybody who follows these systems actually trade? And the reason is it comes back to the person who drives the damn system. If you can't control yourself, if you can't be disciplined, then you will struggle. You'll always struggle, no matter what system you have.
One thing I was thinking about is, how do you balance taking action to, like, when you have a tough time, how do you balance taking action to recover versus sometimes you have to not take action, you just have to let things play out?
The Japanese have a wonderful saying that to take no action is an action. And I've always been a fan of that. It has that sense of calm that says that even by me not doing something, I'm actually doing something. And that requires a change in mindset, I think, that a lot of people don't have. Because it requires you to accept that by sitting still, you're actually doing something. You're choosing not to engage. You're choosing not to be involved. And there are times not to be involved. There are times when market conditions don't suit people like me. So I have to recognise that. And you generally recognise it by your win-loss ratio and the shape of your equity curve. And once you do that, that I think becomes easier. But it's also, I think there is another step in there that's very important, and that is the notion of isolation. Traders must isolate themselves from others, from other people's opinions, their comments, their thoughts, and let everything happen as a result of what you think, what you feel, what your system says. That way you are fully responsible. But being fully responsible is an adult thing. And without wanting to sort of cast too broad a net, most traders, let me rephrase that. Let me be blunt. Most traders who fail at trading are not adults. And they're not adults because they can't take responsibility. Now, yes, I understand that if you're on social media and people are telling you to buy this and buy that, for new traders, that's very seductive. But it's still your decision to follow that advice. That's still your decision. If your broker has told you to buy ABC at whatever price and it literally tanks the next day, that's still your fault. You took that advice. Because it comes back to this really, really harsh sort of bottom line that the money is yours. You be responsible for it. You make the decisions about the money. Don't let anybody else. And once you're responsible, we can take a step back. And again, we can start to look back at the metrics of our own psychological performance. But again, you've still got to be responsible.
Now, you got to tell me more about this. You mentioned the fact that traders should isolate. I hear a lot of people talk about the fact that they like to be around traders to hear their thoughts on things, to hear their perspectives. So how does that play out with the idea of isolating? And I think there's good in both, but I want to hear your thoughts about, like, how does that play out?
I think in many ways they're contradictory philosophies, in that my view is that it is sometimes good to talk to other traders for the psychological benefit, much like, look, you don't want to go down the road of sharing war stories, but it is actually sometimes good to be around people who understand what trading is. Trading is remarkably unique in terms of professions. In that you craft the profession yourself. You decide how you do it. It's not imposed upon you. You don't have, the only working hours are really those you choose, because there's a market open somewhere. How you approach that market is your responsibility. Nobody tells you. Nobody tells you when the breaks are. We can take time out of the middle of the day to do this. We can go out to lunch during the middle of the day. But it is this, how do I put it? There's a difference between sharing that sort of camaraderie with people who understand what it is like versus sitting and listening to people talking about what they're doing, that old expression of talking your book. And I've never been a fan of sitting around traders with them saying, buying this, I'm buying that, I'm selling this, I'm selling that. I couldn't care less, because I know from experience that infects the way you think. And the more sort of authority you give to that voice, the more it will affect you, which is why with students and people over the years, I don't mention what I'm buying because I know it will destabilize them. They will question themselves if they're not buying it. They will chase the position if they think I'm buying it. And this, again, we come back to social media. This is why social media is a problem, because people chase what they think other people are doing without knowing what their rationale is, what their system is, what their risk tolerance is, what they're trying to achieve in markets. Because what people are trying to achieve in markets is not a cookie cutter that you give everyone. Everyone's different. The reason markets work is because of that difference. If everybody saw the world in exactly the same way, through exactly the same lens, then prices would never move, because there would be no disagreement as to what something was worth. You would not have that push and pull between bulls and bears. You'd have this complete equilibrium. It would be an economist's dream. It would be a trader's freaking nightmare, because nothing would move. And so I think there's a difference. It is good to talk to people who are traders when you say to them, look, you will not believe what happened. And they will say, well, you know what? Same thing happened to me last year. You wouldn't believe it. I didn't believe it. But that's different from sitting and talking to people about what you should or should not be buying or selling. I think one acts as a form of comfort and support. It's like being around teammates. One influences and destabilizes, and I think is overall a negative for people.
That's a good point. That's really how I put it, exactly the same thing. So it's good. I want to give you some time to share more about what you're doing these days, where people can connect with you, and the awesome business and tools you provide for traders. So can you tell us more about that?
I'm still busy puddling along. If you want to touch base with me in terms of first port of call is to come to tradinggame.com.au. We have a raft of free resources that you can sign up for, including a free trading plan template, where you can actually sit down and compare your trading plan to an idealized version of what it should contain in terms of the bigger picture items. You can catch me on social media. Unfortunately, I'm on Twitter. You can find me through the Trading Game. You can find me through LinkedIn on my name. And they're the easiest ways to connect with me. And if you want to ask me a question, just drop me an email at chris@tradinggame.com.au, and that will find me.
Awesome, Chris. I know we covered a lot in this interview so far. This is a lot of good knowledge for traders to learn, to go through, and maybe listen to a couple of times, because that's really powerful advice. I want to thank you for being here. Thank you for helping traders and support them along the way. And that's been awesome. And I hope we can catch up pretty soon.